I think that the valuation of the tech companies is actually distorted, so you need to adjust it for intangibles. A big explanation of why the valuation spreads have widened is because accounting rules haven't caught up with how important intangibles are to how they're expensed, so how they impact net earnings, but also the book value, if you look at price to book, for example.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to episode 10 of The Bull of Wall Street. Today we have on a very special guest, Sébastien Page with T. Rowe Price. Very, very happy to have you on, Sébastien. Thank you for participating. And I'm going to turn it over really quickly to Paisley to start out with a few questions, and then I'll be back to talk to you more about your personal life if you'll get into that with us. But Paisley, go ahead.
Awesome. Well, Sébastien, thank you for the time. We're super excited. Just as background, the reason I had reached out to Sébastien to have him join our podcast is I follow him a lot on LinkedIn, and I think he does a wonderful job of balancing the industry that we're in, which is markets, but then also kind of the financial education component. And I know that there's a lot of things that Sébastien will want to address today. As we're recording this on Monday, the 27th, a lot of exciting things going on just in markets and AI and technology. So we'll talk a little bit about valuations as well, the AI craze, and just really the broader kind of 2025 market outlook that T. Rowe Price has put out. So let's jump right in. Wanted to start with some of the softer stuff. And so thinking about this upcoming book that you have coming in the next couple months here, I think we're all super excited. And again, kind of shifting away from just pure markets and thinking about the industry that we're in. And a big part of what you talk about, of course, is communication. So maybe we'll just start so the audience understands this book that you're publishing on leadership and self-improvement. What's the pitch?
Oh, you're putting me on the spot right from the start.
Yes, we're getting right into it.
The book is about using the power of positive psychology to set goals, to execute against your goals, and importantly, to bring people along. There's a lot of personal stories. There's a lot of research. I talk about Metallica. I talk about Snoop Dogg's. I have a story about a human piranha on steroids. There's an attempt at humor. We'll see how it lands. So the title is The Psychology of Leadership, but it's about both leadership and personal self-improvement. And I've just discovered that positive psychology is so underrated in all aspects of business and life. So I hope people will like it. It's coming out April 15th. It's available for pre-sales. So if you're watching this podcast or listening to this podcast, go have a look, The Psychology of Leadership on Amazon, and it's there.
That's awesome. Well, I would say too, I majored in financial markets with a minor in psychology. So maybe that's why I was so excited to have you on. I think this is a relationship business, and I think all of us are human. And so those elements of like, what are we bringing to work every day? How are we utilizing kind of more of those softer skills, increased communication, leadership to not only be better for our clients, but just be better for our colleagues and our peers as well. So maybe I might ask, like, what was the impetus for this book? I'm sure this is something you've had in the back of your mind or in the works for probably years. So like, what was kind of the catalyst for bringing this book to market this year?
You know, the impetus for the book itself was a meeting I had with a sports psychologist. And I don't know if you've you've become familiar with sports psychology, but it's very, very popular right now. Every sports team has a psychologist on staff. And I just met with him to talk about what he was doing. It was a personal interest in how you build resilience. And I had this idea that if athletes, there are lots of things in our industry where investors are like athletes. For example, we don't really control the outcome most of the time. We need to understand the difference between luck and skill. That's kind of happens a lot to athletes as well. And so we had this discussion with the sports psychologist. Wasn't thinking about writing a book, but he starts telling me a story about his best match ever. So it turns out this sports psychologist happens to have 40 national titles in the sport of handball. The sport the quote unquote, the prison sport where you play with your hands and you smack the ball on the wall. He has 40 national titles. So not only does he understand the mental game, but he puts it in practice and is one of the top handball players in the country. And the story was his best match ever, right? And it was so strange what happened. He actually described the match with a lot of passion. He was playing against an opponent that was way better than him. And it was a complete letdown at the end because it turns out he actually lost that match. But that's where this mindset begins, where as an athlete, you learn more from your losses than from your wins. And there's a famous quote by Roger Federer, who went to a commencement address and basically said, I've lost thousands and thousands of points in tennis, and I've learned from them, and all I needed was a little edge to be a champion. So doesn't that sound like investing? And so to me, it was like, okay, this is his best match ever, and he actually lost it. I just started doing the research and learning about sports psychology, about positive psychology more generally. And then I got into personality psychology, which is super interesting. Everybody has an opinion whether they're an introvert or an extrovert. And so you can dig into this, and there are other personality traits that are fascinating as well to study. And there you go. I started writing. I love writing. I'm addicted to writing. So that was, sorry, it's a long-winded answer, but it's been a long project, and I'm pretty excited the book's coming out. So
I love it. Super exciting. We were actually talking about introvert versus extrovert on our podcast last week. So very timely. Jimmy, did you have a question? I felt like I cut you off.
I got one. I'm very, very interested in the subject, and right now, if you, I don't know if you guys saw the Chiefs game yesterday against the Bills. I mean, for your Buffalo fans, I mean, you guys have an amazing team. Josh Allen is an incredible quarterback leader, but the Chiefs, and we have offices in Kansas City, they just have an edge, and the number of wins that they have that are in the last drive or single digits or whatever the heck, they win all the close games, and so it's obviously part of their culture too. But one of the things, Sébastien, I wanted to ask you about that is, have you studied much about the subconscious? And obviously in sports, that's something that I know a lot of the psychologists and coaches talk about, but I'm a big believer in that in terms of understanding our own subconsciouses and how important that is in our day-to-day lives, whether we know it or not, right?
I think it's incredibly challenging to be a pro athlete. It looks like a really nice life, but it is incredibly stressful. If you ever get a chance, read the book Open by Andre Agassi about how much he actually hated tennis. So the inner life of athletes, whether it's subconscious or conscious, is challenging. And most of them score very high in neuroticism. Talk about another personality trait. And this is so similar to active portfolio management. There's a lot of uncertainty. You don't control everything. And here's the key and where the connection gets made. Those athletes that focus on process and that derive satisfaction from improving their process tend to succeed over time. And if you take this to an extreme with the sports psychologists I met, if you're obsessed with getting better at your process and you derive satisfaction from improving your swing, you don't care about the score that much. Everybody cares about the score, don't get me wrong. But you improve your golf swing and you get excited. Your process is getting better. Isn't that similar to investing in a way? You know, we think about process in our organization as active managers. Are we spending our time efficiently? Are we communicating efficiently? Are the best ideas likely to surface in our process? Do we run the meetings the right way? This whole process orientation, it's not really about subconscious versus conscious, but I think it gets you out of a lot of biases, inner turmoil, subconscious or conscious, and it just makes you more resilient over time.
It's
which is, yeah,
I was just going to mention, it's interesting too. I mean, our industry is known for being kind of like a feeder industry for a lot of athletes. I just remember when I was first entering like Wall Street and a lot of the interview questions, and there was a lot of similarities, I would say, in having a lot of, whether it was high school or college level athletes entering financial services industry. So I think that's a pretty interesting connection. Tally, did you have a question you wanted to ask as well?
Yeah. Well, I have a leadership question, but I love the discussion around positive psychology. I did read your latest missive, Sébastien. By the way, it's great to meet you.
By the way, great job pronouncing my name with a French pronunciation. Well done.
Sébastien Page.
Yeah, well done.
Of course.
Tally's Canadian.
Yeah, we'll get to that. We could have started there, but this is okay. I'm going with the flow. So not too long ago, you made the point. I think it was you, Seb, that the fight or flight response can be useful for accomplishing simple tasks, like moving from point A to point B quickly. However, that same kind of high pressure, high intensity response is really less than ideal for carrying out complex, thoughtful projects like, I don't know, like writing a novel in your case, or symphony, maybe in my past life. But in my career, I've had more than one manager, unfortunately, who didn't really understand that distinction. And I hope that they watch this episode, because I'm going to make them watch it. But my question to you is, why do you think so many managers get that wrong? Is there too much emphasis on deadlines and not enough emphasis on quality of outcomes? How do you balance the two?
So I love that question for so many reasons. First of all, you're clearly reading what I put out on LinkedIn. Second, I talk about this in the book, and there are applications to leadership, but also to personal resilience. The idea, first of all, that all stress is bad, and we kind of hear this, right? It's unhealthy to be stressed. And there's studies where they hook monitors and they look at your cortisol levels and they say, look, if you're constantly stressed, it leads to burnout, it leads to poor health. But it's much more complicated than this. In fact, research in psychology, decades of research in psychology, show that athletes, for example, perform best at a certain stress level. And they draw curves. Those are called Yerkes-Dodson curves. You can look it up. And when your stress increases to a certain level, you become more activated, you become more motivated. It forces you to prepare because you're a little bit anxious about what's going to happen. You're more switched on, and you perform better and better and better. But then there's a peak, and you choke. After the peak, you choke, and your performance goes down because your stress level then becomes detrimental. So that's the premise. It doesn't address your question directly, because your question goes one step further, which is different tasks have different stress curves. Simple tasks, like a sprint, or think of a power lifter. There's no level of stress where you actually decrease your performance. You need to be, and psychologists they call this activation, not necessarily, it's a broader definition of stress. But if I put you on a treadmill and I say, run the fastest you can for the next 10 minutes, The more activated you are, the more you feel the adrenaline, the more stressed you are about this, all else equal, the faster you're going to run. And it's a simple task. Or same for powerlifting. However, if you're going to do like archery or a deep work, deep concentration, writing, analysis, then you're going to peak. You still need some activation because otherwise you're not motivated, you're bored, and you're just not going to perform as much as you can. But you still need some activation, but the curve looks different. And I love the point you make about how managers don't necessarily understand this. They'll put pressure on everyone equally, right? But if you have someone who's doing manual labor, for example, you can put the pressure and put some stretch goals. But if you have a research and development team, it won't really improve the performance of the team to just crank up innovate, scream at people to innovate.
Yeah, right.
It just doesn't work that way. So I have a whole chapter on this on the book. There are lots more examples. And I show the types of tasks where it's okay to be stressed, and I can distract you even, like put some very loud music and you're going to perform, and other tasks where you need concentration and you're going to peak at a lower stress or what psychologists would call activation level.
Awesome. Thank you.
Maybe another question I had is, in the book, you talk about core assumptions. Like, how or why do these matter for investors?
So core assumptions are the filters through which we interpret the world. And they're a big deal in psychology in general. A psychology example would be, for example, someone whose parents divorced early in life, and it changed how they think about conflict. And generally, for most of their life after this, their core assumption is when there's trouble, you run away. You go away from the trouble. So that's a psychology example. But if you step back and you say, what are core assumptions, for example, in the investment world? Well, stocks for the long run. Some investors view the investing world through that core assumption. Value investors, I think Warren Buffett has core assumptions in investing. Look at companies that have strong cash flows, great management, and that trade at a reasonable price. Growth managers have different core assumptions, different filters through which they interpret the world of investing. Growth managers like to be on the right side of change, and they're looking at the trend and using imagination. It's just a different way to think of the world. And back in the day when I worked for a large bond manager on the West Coast that some of you might know, there was a core assumption going around the trading floor about risk management. And I love that one. It was, the road to hell is paved with positive carry. And that core assumption of fixed income investors and risk managers is that you can always add to yield. And it feels better for your investors. We all love yield. But at some point, there's a tail risk that builds in the portfolio that the thing blows up.
Yeah.
So all these core assumptions, I think, are important to understand if you're an investment leader, but also if you're an investor yourself. Just step back and think, okay, how do I typically interpret the world? What are my investing core assumptions? Are they the right ones? Because sometimes they're not productive. They're hurting our investment process. And then you begin to manage them more actively. So again, this is a good example of what I want to do with the book, which is take a concept that's backed by research in psychology and apply it in the real world and reflect on how it's impacted my own work. There's a lot of personal stories in there about how I've thought about these things in my own career, which is approaching now in 25 years. I know I look young, but
Very impressive.
I don't look that young, actually.
You look great. By the way, Jimmy and I just came back from a week in Newport Beach visiting with that manager.
I'm gonna guess that the weather was nicer than it is now on the East Coast.
Yeah, yeah.
I didn't do a proper job of introduction since it's a 10th episode. I figured people know who we are, but we actually, so Tally is our chief market strategist at the Wealth Consulting Group, and Paisley consults for our investment strategy committee, and used to work at PIMCO for a few years back, so she knows what you're talking about, I'm sure, and is currently a managing director at Simplify. So anyway, you're a very interesting guy. You're not the typical CIO, head of global assets at a multi-trillion-dollar firm. I like this, and so I know that Tally's going to probably ask you about your upbringing, and I'll switch gears. So maybe Tally, you can
Perfect.
get us set up for how you grew up and where you grew up and
Yeah.
your story.
Well, that's great. So Seb, this next question's about literacy and language, and I love this because I'm always talking markets and economics, so it's a breath of fresh air. And like Paisley, it sounds like I've seen some of the financial literacy videos of you and your daughter, and I think you guys just do a fantastic job there. I'll share that my dad was from Montreal, Quebec, and that's where my last name comes from, Léger. No one can say it
Yep.
right, but that's okay.
Léger.
But I thank you for that. I was born and raised in Ontario, the Anglophone side, where I went through the French immersion program, and I think that's gone now in Canada. They also used to have a grade 13, but I think that's gone too. So a lot has changed. But I know you went to Sherbrooke, which is a French language university in Quebec, and I wanted to ask you what kind of challenges did you face learning and thinking about financial concepts? Because I think you studied finance, and I'll let you answer the questions. But learning those concepts in one language and then applying them on the job in another, how did you manage that transition, and how do you guys handle it at home? Are you a bilingual household?
So you're right. All my studies were in French all the way to my master's in finance. When it came time to do a research project, that's where I got a sponsorship from State Street in Boston. It was nerve-wracking, incredibly difficult to switch language on a dime. All I had was the usual high school class in English and the summer hockey camps in English. But right. That was it. And I was incredibly self-conscious about this. And for example, when they asked me to write a one-paragraph description of the project I was proposing, I spent the whole night up writing those 3 lines. These were my first 3 lines in the professional or semi-professional as an intern capacity. And so I decided right away that I would stop reading. I read a lot. That I would stop reading in French and switch to English. And you could say I'm basically self-taught beyond sort of the basics. And over time, I was in front of clients a lot. I was self-conscious about my accent. And I took accent reduction courses, but that was very, very difficult, and I kind of gave up. So you can probably still detect some of it even after so many years. But I do think that, and this has been shown through serious studies, that people that handle 2 languages you develop the cognitive muscle. It's actually good for the brain, good for the learning process. And so it wasn't a bad thing per se. And here's the twist now. I've come full circle because I've been talking about finance now for 25 years in English. I often get requests to present in French.
That's
in
great.
Montreal or Quebec City.
Yeah.
And I almost have to turn them down because when I do accept, it's incredibly difficult to present in French because all the finance words that I know I've been using for 25 years, they're in English.
Of course.
So the level of preparation is extreme. It's hours and hours of sitting down, translating the terms, You don't want to do Franglish in Montreal or Quebec. You just, if you're going to do it in French, you have to do it in French.
That's right.
And so this, it's come full circle now. At home, I speak French with my wife. She's French Canadian as well. Both our kids, I'm going to be honest, speak mainly English. My son's taking French classes. A lot of families have the self-discipline in the process to keep both languages equally important in the household. We failed at that.
Yeah.
But they have decent French, put it this way.
That's great.
It's interesting you mentioned the accent reduction coursework that you did. So different, but similar in some vein. I grew up in northern Minnesota. And when I moved from northern Minnesota out to California, for the first several years, I was working on a trading desk. I would get made fun of every day for my Minnesota accent. And now when people meet me, they have no idea. The O's and the A's will come out once in a while. But I know what you mean in regards to wanting to kind of sweep that under the rug, because it does end up sometimes becoming a distractor, even if people have good intentions and mentioning an accent. It just felt to me personally like a distraction. So I didn't take accent reduction courses. I say I took Rosetta Stone for just normal English speaking, I guess. But yeah, that resonates with me for sure. Jimmy, did you want to take us in another direction? I know that ultimately we, of course, want to get to our industry topic, which is 2025 Outlook. But before we jump there, is there any other topics that you wanted to broach on, Jimmy?
Maybe just a little bit more on your passion for leadership. I mean, I just love it. That's what you're writing your book about. And then obviously listening to you talk today, there's a lot of, examples of how that relates into the business you're in professionally and the business we're in. And so if you want to talk more about that and just why, besides what you said so far, why you're so passionate about it. What you said about the process reminds me of one of our clients who is a former very famous basketball coach, but, he says that everybody's got a will to win, but not everybody had the will to, prepare to win. And so it resonates with me.
Leadership at the end is not complicated. It's difficult, but it's not complicated. You are the one setting the goals for the organization. Because if you're not setting the goals, especially the long-term goals, no one will. That is the job of the leader. And then you also need to excel at execution against goals. Execution in a world that is unpredictable. You need to separate signal from noise. You need to decide when the goals are no longer valid. But it's really important to be able to do both. Set the long-term vision and execute against it, recognizing that things will not go according to plan. So the first two sections of the book are about that, setting goals, and this is where positive psychology comes in. You even need to think about goals about relationship, about process, not just the measurable goals. And then execution, separating signal from noise, a big part of leadership, a big part of investing. And then the third part is you really need to show empathy as a leader and understand people. And what's very much counterintuitive is that you need to listen more than talk. And one of the most underrated, most important skills of leadership is to sit, be present, and listen to people you work with. And that's where also the personality psychology becomes really interesting. If you understand who's an introvert, who's an extrovert in your team, that's super helpful. And there's been research about this. There's been books published. Introverts tend to be sometimes underrated. You need to call on them and bring them in the discussion. But there are other traits as well. For example, and I can ask you to rate yourself on these traits. If I ask you if you're an introvert or an extrovert, can you actually classify yourself on that scale?
I'm fully introvert.
Fully introvert?
Yeah.
I would say I'm introverted, but I have a lot of training on how to be an extrovert, and that comes from my background in performance. So I'm always presenting. I think I'm balanced that way because I have to, in order to get out there and tell the story, I have to do my work first. And if I don't do the work first, I don't feel comfortable.
Yeah.
But I don't want to be doing the work 100% of the time either. So it's a nice balance, I think.
And I'm naturally introverted, but love being around people and get energy from the right people, and so it's interesting, but I'm naturally introverted.
So here's four of us. I consider myself generally an introvert too, doing a podcast that is essentially an extroverted activity.
Yeah.
Right.
It's actually much more situational than people think. And so you can be an introvert in some situations, an extrovert in others. But where I think the book is going to make a huge contribution, there are four other personality traits that are important, that drive behaviors, that help you build empathy, that help you understand your team, that will help you bring people along, that will help you construct teams that are very much diverse in how they think. So one is conscientiousness. Do you have a habit of being super organized, on time, neat, clean desk? Or are you a little bit more freewheeling, creative, might come across as disorganized, but there are positive sides to being less conscientious. You can act quickly, make big decisions quickly. We'll run out of time, but just where are you on the very conscientious or less conscientious side? Most people in our business are on the high conscientious side. They're
somewhere in the middle for that, for sure.
Somewhere in the middle.
Yeah.
And if you have habits where you do the same thing every day, that's a way to actually increase your conscientiousness, right? Using the power of habits.
We use Colby in our firm for assessing the innate personalities of all of our people. So do you have a favorite tool that you like to use with your team?
So in the Big Five, in the book and how I think about it, I use the Big Five. So extroversion, conscientiousness, neuroticism. Do you tend to get anxious, or are you pretty relaxed about things? Openness to experience. Do you like to try new things? Do you easily get bored, or are you comfortable in a routine? And agreeableness, which is interesting. Are you someone who generally tends to defer to others, and are you someone who wants to please others? It's actually a good trait for leaders to be somewhat agreeable, because again, you need to bring people along.
Yeah.
The research shows that there's actually a positive correlation between leadership effectiveness and agreeableness. Now, I got to tell you, there are tests you can take on the Big Five or any other personality model, and my score on agreeableness was much lower than I thought it would be.
Oh.
So it's very fitting that I will say I disagree with my score on agreeableness.
I see what you did there.
I was at Invesco with Paisley, and the assessment that I took was the DISC profile assessment, which is another kind of framework. But interestingly, my colleagues told me that they could have told me that without taking the test, but I came out as a high dominant. That was, anyway.
Yeah, I was as well. I think they put the results up and I was way on the edge of the circle with all of the analyst portfolio team, which again goes back to understanding yourself, but then also those that you work with. I think it should be necessary really at any level of management to have a pulse on who you're managing, so you can just meet them where they're at, best support them, help build skills if there's deficiencies. But the way that you interact and get successful results from people is very different based on how they work, how they think, how they meet.
Let's take conscientiousness, right? I have people on my team, I know they're very conscientious. I have others, I know they're less conscientious. If I have an allocation committee tomorrow, and I need to look at what's going on with AI and how it's correlating with value versus growth stocks, but it's tomorrow, I'm actually going to go to a lower conscientiousness person
Ah,
because they're going to be satisfied with giving me 80% of the answer.
Yeah.
They won't sweat the econometrics. And because they're experienced, they'll give me the best answer in a short amount of time. If I want to do an in-depth study of a risk management problem, I'm going to go to a high conscientiousness person because it needs to be very detailed. So it really is, I think, something that a lot of leaders do by intuition.
mm,
They learn to know people, but putting this framework around it, stepping back and thinking about it. Look, there's a risk that it becomes a little bit like horoscopes. Like you interpret everything, you read, oh, that's me. That personality psychology only explains a proportion of behavior. It's somewhat heritable, somewhat not heritable. You can change your personality over time. It's not an exact science, but it's a really useful framework. And you at some point when I was researching this, I would sit in a room, and let's say it's a fairly boring meeting. I would go around the room and mentally try to get a score on the big five for the people in the room, just as a mental exercise to get to
funny.
understand people around me.
Yeah.
It's a lot of fun. I have tables in the book that show celebrities on both sides: high conscientiousness, low conscientiousness, extrovert, introvert, high neuroticism, low neuroticism. I kind of made it up, but they're pretty well known, so you can know on which side they're on.
I love that.
Hey, Paisley, can I ask a question? So we're talking about frameworks, and maybe I can use kind of a related question to segue into the 25 outlook here. So at the Wealth Consulting Group, we have global, tactical, and strategic asset allocation. I think everyone pretty much does, but we have these different buckets. We've got there's macro, there's technical, there's fundamental, there's quant, there's behavioral, and that's kind of our framework, and we have to assess it all. What is your framework, and like what are the things that you look at when you're setting investment policy, and how do you kind of balance all those different forces and concepts in your day-to-day?
It's similar. We have very long-term models for life cycle investing, Monte Carlo based. Then we have strategic asset allocation, portfolio construction. We use judgment, optimization models, risk models. And then we have tactical asset allocation, which is 6 to 18 months. We look at relative valuation opportunities. We also add fundamental factors, macro factors, and then sentiment and positioning. And this is a process that takes place monthly in an asset allocation committee that includes investors from throughout the firm: stock investors, fixed income investors, and multi-asset from the division that I oversee. And, speak of core assumptions, you'll see the fixed income investors tend to be a little bit more bearish. You'll see the stock investors tend to be a little bit more bullish. You can see the core assumptions in action. But so our process sounds very similar to yours. Where ours is different is that at T. Rowe Price, we have over 300 stock analysts and company analysts. And there's a tremendous amount of deep company level research that takes place. Mm-hmm. And we've set up the process so that bottom up information flows through to the asset allocation discussion. So we'll have a portfolio manager in the committee and we'll say, okay, we're looking at small caps. What are you seeing at the company level? And they'll give us insights on, well, right now there aren't really good investments in that space, and here's why. Here's some of the companies I'm looking at. That's, to me, is a differentiator. We've really figured out how to approach the information flow from the bottom up and from the traditional top down.
How important is dissenting opinions? I would imagine, like, overseeing that type of multi-asset committee. I mean, you would probably, especially given the psychology background, welcome kind of cognitive dissonance and thinking about just different ways of approaching the markets. I would imagine it's also quite overwhelming because you have all these different asset classes, which have different biases, beliefs. So I know it's a very broad question, but just in general, like how does T. Rowe Price and how do you individually think about kind of those dissenting views and kind of bringing that together from an amalgamation of the broader firm?
In the asset allocation committee, it's so important that when we're all in agreement about a trade, we get worried.
Oh,
We
yeah.
get worried that we're all on the same side of the boat and that we're missing something. So members will regularly play devil's advocate. Here's another way to look at this. You need to have a really special culture to do this right. You need to have trust and mutual respect. And where someone disagrees with you, it's not about you. Your idea is not you. And you become comfortable having ideas collide and figuring out all angles. I can tell you when I do research, when I look at a position in our portfolios, what pushes my thinking the most, where I end up in a better place with more confidence in my views, is after dissenting opinions. Because you just, if you can avoid getting in a fight or flight mode, you just start thinking deeper and you get the power of the group. It sounds trite. We collaborate to get the best out of the team. It's actually super hard to do. It requires a special culture of trust and mutual respect, because otherwise it just is, first of all, it's not fun if you take things personally. And second, it kind of eventually falls apart. It just becomes an individual sport. So Paisley, super important.
Yep. And I love that too. I mean, my personality type is one that naturally actually enjoys pushback. Like I love having, I don't want to call it a heated conversation, but like you said, playing devil's advocate, looking at kind of all sides of various people's viewpoints. I think that maybe that's a great segue going from the psychology more to the investment now and thinking about your role at T. Rowe Price. And I would imagine as your team came together to put the 2025 market outlook together for client use and industry use, there was probably a lot of dissenting opinions or different unique ways to look at the markets. So maybe I'll just start by, would love to get an overview of like, what are your team's views right now as we enter 2025? I don't know if anybody had a competitor to NVIDIA on their bingo card. So I think like as news is coming out in these last few days, there's a lot of volatility in the marketplace. I think that is one thing that was probably expected. So I'd just love to hear, what are your team's views in particular? And was there anything that was maybe surprising for you personally coming out of that kind of amalgamation of views?
So as we record this, the drop in market value for NVIDIA, now that there's an AI model that can be trained for $5-6 million instead of $100 million to $1 billion that can achieve top 10 status. Well, as we record this, not sure when this will air, but the drop in market value for NVIDIA is $560 billion, which is the largest drop in history. But this is the tyranny of high expectations. Valuations for those companies are incredibly high. And they're justified in a way, but this example, we discover an AI coming out of China that is just much more efficient. It just shows that when you start with high valuations, there's fragility. There's fragility in the market, and the tail risks, the risk of a large loss increase. We'll see what happens with that one, but I'd like to answer your question more generally, though. I'm optimistic about the economy over the next 12 months. The economy is doing fine. Atlanta Fed GDP now is at 3%. The composite PMI is at 52, which means we're in an expansion. The City Economic Surprise Index is in positive territory, and it's much higher than it was 6 months ago. And we have fiscal spending basically pedal to the metal, which is stimulative, can create problems with deficits, but it's stimulative. The Fed is really still accommodative. I mean, we're putting liquidity in the system still. You had positive numbers recently for retail sales have momentum. You know, people have jobs. 4.1% unemployment is higher than we were at 3.4, but by historical standards is very low. The long-term historical average for unemployment is 5.6. So you have a fully employed economy. So the consumer is spending, at least a high-end consumer. And the high-end consumer has made money on their stocks, so there is a wealth effect for spending. Industrial production just surprised on the upside. The manufacturing data is actually finally getting out of a funk and starting to move up. Maybe that's front-loading tariffs and so on. You can look at new order data. But I mean, should I go on? Like, the economic data is showing very decent growth. For the next 12 months. You have deregulation that should help. You have pro-growth policies, lower taxes. Who knows how much we're going to get versus what was promised on the campaign trail, but all of these policies are pro-growth. So before I sound like a raging bull who wants to be overweight stocks, this is consensus. You know, the market is trading at a price earnings ratio of 22. And there is the tyranny of high expectations. You're seeing it today with NVIDIA. And, you know, when I say there's a level of speculation in the market, I sometimes refer to 2021. Remember how much speculation there was then? Meme stocks and NFTs. And someone in 21 paid $1.3 million for a JPEG, a picture of a gray rock. And however, now I'm often reminded when I use that example of speculation that recently someone paid $6 million for a piece of art consisting of a banana taped to a wall.
Yep.
And he ate the banana. And by the way, those rocks basically crashed, but they're back at 600,000. So we're not in 2021, but the price earnings ratio at 22 is in the 95th percentile.
And I think even last quarter, we were having a conversation about this dislocation of fundamentals and technicals. And it just felt like no one cared about fundamentals in the last quarter of 2024. It was like up, up, and up. People were not necessarily looking for anything to go wrong. I feel like a bit of that sentiment with maybe some of the pullback we saw in late December, early January has people feeling a little bit more rational. And now we're almost again like looking for some of these catalysts for a pullback. It's a weird environment to be in, though, just broadly thinking about like we hope there's a 10% pullback in the market because then it's a buying opportunity, right? So like the psychology of how we think about entering markets and the expectation for long-term returns is also it's a bit mind-blowing. But again, going back to your comment on expectation coming into this year is quite high. And much of the data supports kind of the continued bull market. And this is the Bull of Wall Street podcast. So I think it is fitting, but didn't mean to cut you off. Just wanted to share my thoughts.
No, I mean, you know, the expectations for earnings growth is 15% next year. So you don't really need, if we can hit that, you don't really need a lot of price earnings expansion. The other thing is, I don't think we're in a bubble. We're fully invested between stocks, and we actually have a small overweight stocks. It's not large, but it's different from, say, 2000. There's 30% of the indexes in technology that justifies a higher valuation. Now, you might say we had concentration in technology in 99 as well, and look at what happened. But the return on equity is very different. If you adjust the price earnings ratio for the level of the return on equity of the market right now, going back to your point on fundamentals, you're down from 95th to 98th percentile to 70th percentile. So it's tech heavy, but it's a tech sector that has a much higher return on equity than it did during the tech bubble.
Mm-hmm.
It's like in the 30%, and the tech bubble was in the sort of 17%, right? Leading. So it's a different thing. NVIDIA just created in about 2 years about 30 billion in new net profits. And so this is not borrowing growth. It's not levered growth, right? It's cash rich, large companies that are growing fast. And there's a real innovation here, or a set of innovations in AI.
Yeah.
But again, I don't want to sound like the raging bull, even though we're on the bull of Wall Street. Unemployment is trending up, and historically, it's very hard to stop the trend when unemployment starts to increase. And we are still in a contraction on the manufacturing side. Rates, if they go much higher on the long end, that ends up being restrictive and it poses risks. I think there's positive risks to inflation. In other words, inflation could surprise on the upside. And then geopolitics are always part of the equation. They kind of don't matter for markets until they do.
Yes, until they do. Maybe on that topic, actually, for rates, and just talking about equity valuations, thoughts on, with the backup in yields, the impact then it has for like discounting future cash flows for a lot of these more tech heavy, longer duration equity assets. Does your team have any views on kind of tempering expectations or euphoria in the equity space, just given that backup in interest rates?
I think so at some point, because we've been trending up and we're a little back down now over a week. And we haven't seen the impact on growth stocks underperforming value stocks. You can do this nice historical chart of growth versus value as a function of the level of the 10-year yield. And you'll see that what you just said, that growth stocks generally have more duration. So if rates go up, value outperforms. Value has financials, which ultimately through net interest revenue, because they borrow short-term and lend long-term, a steepening yield curve is actually good for financials to make money.
Yep.
All of that went out the window when AI came around.
Mm.
And you had rates coming up and growth still outperforming. And then growth is just, in the US and large cap stock spaces, just been outperforming value for 15 years.
Yeah.
And so I published, is this no time to talk about this, but I'll encourage your listeners to look it up. I published a paper in the Journal of Portfolio Management titled When Valuation Fails. And it's a look back at 15 years of US outperforming Europe and the valuation spread widening, growth outperforming value, large outperforming small.
That's great. Yeah, we'll definitely take a look at that.
I want to ask a question about that because, and the three of you. So Sebastian. I'm the only financial advisor on the call. I don't know if you ever were a financial advisor. I don't think you were. Tally was an advisor for a minute or two, I think, in his career, or a year or two. That being said, I saw a chart recently. Give credit to Ritholtz Wealth Management, but we've been in recession for 2 months. I mean, they're not the only people that know this, obviously. We're only been in recession for 2 months in the last 15 and a half years. And being classically trained CFAs and or, economists like yourselves, is it different now? I mean, never in history, I've been in the business for three decades. Have we ever had companies of this size that can create the growth on the top and bottom lines that they do at these crazy valuations? I mean, they don't depend on bank financing. They are not like a normal, even within tech, right? Is it different? Is that why, like you said, 30% of the market deserves a different valuation? But is it really different now?
I think that the valuation of the tech companies is actually distorted, so you need to adjust it for intangibles. A big explanation of why the valuation spreads have widened is because accounting rules haven't caught up with how important intangibles are to how they're expensed, so how they impact net earnings, but also the book value, if you look at price to book, for example. So it's valuation will reassert itself. I think we're close to a tipping point where the market should broaden over the next 6, 12, 18 months.
I hope so.
These companies aren't necessarily that expensive if you adjust for their margins, for their gross margins, for their earnings growth, for their ROE. Interestingly, you have a whole world of stocks out there beyond the Mag 7. And if you look at the average stock in the world, the MSCI All Country World Index equal weighted, the price earnings ratio is around 14, which is actually the 30-year average price earnings ratio. So when you include everything, small caps, EM, Europe, and so on, you conclude that the average stock in the world is trading at an average valuation. And so that's a completely different lens than just looking at the S&P 500, and it speaks to a potential eventual market broadening. When you look at an average valuation, it's like the statistician who had their head in the freezer and their feet in the oven, and they claim that on average they felt great.
Right.
The valuation looks on average to be expensive, but it's a barbell between very reasonably priced stocks and very highly priced stocks.
So maybe on that topic then of market broadening, how are you guys thinking about asset allocation in 2025, whether it's value versus growth, stocks versus bonds? Like what are kind of the key takeaways from your team?
And sectors.
And sectors.
So we're slightly long stocks, although if markets keep ripping, we're kind of trimming that position at the top and starting to pull out of stocks, just going back towards neutral, not being overweight. But we're still overweight. And we're long the broadening in a few ways. We like international small caps. They have higher return on equity than US small caps, and they've been punished as much as US small caps. We like EM, but we're underweight China. Some of the countries that our portfolio managers like in EM include Argentina, Brazil. There's security-specific opportunities there. It's all active management. We like value stocks in general, but we're neutral between large and small. So this is the broadening we're playing. Some value, large cap value, some international small, and some carefully selected EM exposures. That's how we're looking at the next 12 months. And slightly overweight position. We're underweight duration, so we have an overweight cash as well.
Underweight duration. So that would lead, and maybe I'm making an inference here that isn't fair, but if you're underweight duration, there's an expectation that rates may likely continue to back up further from here. Because I know right now that's pretty polarizing opinion. A lot of people on the street think that this is a great time to add to duration. Tally, any thoughts like as it relates to our team here and how you guys are thinking about duration?
Well, so on that note, maybe I'll kind of ask a bit more of a philosophical question. So, and that kind of gets to it. So up until recently, the correlation between stock prices and bond prices has been positive. And I'm okay with that as long as they go up together. But PIMCO feels differently. They think as inflation cools, we get back to a low or flatflation environment, that the correlation will change. It'll become negative. And I guess what I struggle with is I can't really see how what's good for bonds will be bad for stocks. So what camp are you in there, if you get my drift?
If you get inflation or rate shocks, it's quite possible, in fact, it's more likely than not, that stocks and bonds can go down together. And there you get a positive correlation on the downside. Treasuries no longer diversify your portfolio. We saw that in 22, and if you like to study data like I do, it happened a lot in the 70s as well. So the question you're asking is, are we going to get rate or inflation surprises over the next 12 months that might bring both stocks and bonds down together? I think that's quite possible. And therefore, if you have cash, if you have real asset equities, for example, if you have hedges in your portfolio, you'll be able to get some diversification on the downside to replace the treasuries, which aren't really going to work again if you get those shocks in rates and inflation. If we all move towards being worried about growth, and you saw that a little bit in August, this was remarkable. You got a bad non-farm payroll print, and all of a sudden the market got worried about growth, things sold off, Japanese carry trade on one, Japan went down, and then right after we got a few more better data points, and I think a famous sell-side firm changed their economic outlook and then changed it again in about 5 days.
They remain flexible.
If that's the regime we're going into, where growth becomes a concern, and let's not get complacent. I gave a lot of data points that show that the economy is doing just fine, but we're not too far from a knife's edge where things can tip. Then yes, treasuries should rally, especially if inflation is coming down. I still think that a massive growth, maybe even geopolitical flight to safety, should lead to investors buying U.S. treasuries, even though we have a big deficit, because it's the most liquid asset, and it's still, the U.S. still has a privilege that people want to buy it for protection. There aren't many other safe assets you can think of.
I appreciate the answer, because what we're talking around is basically the fallacy of diversification. It doesn't matter if correlations go to 1. Nobody's safe, right? Sorry, Jimmy.
And then you hedge. I mean, I always like to say, if you can't diversify, hedge.
Right. But do you see a scenario where inflation could be a bit lower or much lower than what's expected right now?
So the new rents for new tenants are coming down. They're actually year over year negative. And that is highly predictive of a shelter inflation number that's going to come down and down and down. So the base case might actually be that we continue coming down. The problem is that commodities, as an asset gator, I'll say, the most unpredictable asset class. Commodities can drive headline inflation in the short run and all of inflation in the long run higher. Look, at the end of 23, we had 3 months in a row we're running at 2%. We were there. And then the first 3 months of last year, if you annualize the headline, we were running at 4.5. We just printed 0.4. If you're a runner, we're all supposed to look at annual numbers and all that stuff. But if you're a runner, you look at your watch, you like to know how fast you're running at a point in time. Well, last 3 months, we're running at 3.6 headline average, and we just printed headline 0.4, which is 4.8. So if we get a few prints like this, maybe we put so much pressure on Iran that there's some disruption of energy markets. I'm not a geopolitical expert, but someone told me to be very worried if we start hearing Strait of Hormuz disruptions, which is always possible, maybe a tail risk. Then we're there. We're back running at 4.5, 5 for a few months, and it'll be interesting to see what happens at that point. So the commodities are the wild card. I also think the goods disinflation is pretty much done. We had the normalization. Used cars are growing at an annual rate over the last 3 months of about 20%. So they've kind of bottomed the disinflation in used cars, and now they're coming back up. So, and by the way, we have a housing shortage in the U.S. So it's not a given that we'll trend a straight line down. Yeah. There are risks there.
Yeah. I'm just being cognizant of time. Don't want to keep you too much longer. I'm sure you have other things you need to get to today. But Jimmy, Tally, any other questions for Sébastien?
No, I'd just like to thank you for a nice, balanced conversation. That was great. Wonderful.
I've got one last question, Sébastien. What hobbies do you have? Or did you play sports growing up? You look like you're still exercising a lot. What do you like to do for fun?
Okay, I played ice hockey. I played soccer. I never really was good at any of those sports. About 10 years ago, I read an article about someone who had exercised 365 days for the year. And I thought, that's impressive. Maybe I should try to exercise every single day for a year.
Wow.
And I've done that for 10 years. I have a disclaimer. I have missed a handful of days. I had
I'm still
sinus
impressed.
surgery.
Wow.
I had my appendix taken out, so I had to take a few days off.
Good.
But I basically have an unbroken 10-year streak. And now this actually is not healthy if you go all out every day. So often when I feel run down, what I do is I just take it really easy, run at a slow pace for 30 minutes just to keep the streak. But to me, I actually talk about this in my book, is if you want to become more conscientious, just build some habits and streaks that you don't want to break. And that just helps. It's just much easier that way.
Yeah, I was just gonna say we did 75 hard at Simplified, and like really like the fourth quarter of this year, and it's pretty fascinating how quickly the body can adapt, for better or for worse, when forced to do something. And coming out of that, I mean, the natural inclination would be like, let's eat a bunch of junk food and let's relax and watch movies. Your body now appreciates and is almost like fiending for like the continued movement and health, being healthy. So although 10 years is extremely impressive, I don't want to undermine that. You can see how, like, once you build those habits, you don't want to relinquish them. You want to keep up with them. And it becomes a bit of a healthy addiction in that way.
I listen to Peter Attia's podcast a lot, and I don't even think he does that. So is it mostly running, or you do other stuff besides cardio?
Yeah, look, you're not supposed to do this per se, right? That's why you have to modulate and take days where you take it really easy, but you still check the box. You're actually supposed to take days off, but I just do it for the streak. I do a little bit of weights 3-4 times a week, and then I run maybe 25 miles a week, depending, something like that.
And before we sign off, I know you like listening to podcasts or watching podcasts. What are your favorite few podcasts you can mention?
I'm a huge fan of Tim Ferriss. I really like Adam Grant. My favorite podcast of all is The Bull of Wall Street.
We paid him to say that.
Thank you. Thank you, guys.
Yeah, no, appreciate it. And just as a reminder, Sebastian's book, The Psychology of Leadership, is out in a couple months here, April 15th, which can be pre-ordered. But just again, want to say thank you, Sebastian, for sharing with us a very unique perspective on the industry and leadership and psychology. So really fortunate to have you join us.
Thank you. This was a ton of fun. So anytime.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.